Good afternoon. This is October 26th, right? Part two of part three in our election update. Exciting time over the weekend. Obviously, you had in-state voting started in New York. The lines have been very long. I was telling Seth today that on the way in, I actually went by a polling place in Fishkill. Lines are around the building, and so it's pretty exciting to obviously go through that. And in most states, New York included, we never really had in-person voting ahead of the actual election day voting. So be quite interesting whether this goes right up to the election day or if it just kind of just peters out a little bit as it gets closer, and therefore maybe not having a lot of people that go on that day to vote. But safe to say, it's very interesting times to say the least. So we want to kind of go through part two today for you, continuation from our last video, and give you an idea as far as how it relates for you with your portfolio and how things look today and what we've kind of done to prepare for what we kind of feel is a lot of volatility back and forth, depending on who gets in or not. We're going to have some challenges as we get ready for, let's say, the next 8 days. So three topics we're gonna both include today. What have we done so far? What are we going to do in the short term, and then where do we eventually get to as we go forward from here? So let's spend some time talking about the portfolios, especially when we talk about what have we done. I always go through, this, I guess the best way I can explain it is sort of a weight loss, type of analogy. People sometimes don't understand that when we go through a drop in the market, how much more that you've got to make up when you have a loss like that. Weight loss is the same way, right? The more you lose, the more you put on, the harder it is to take it off. And so it really is that type of situation too with the market. The more we lose, the harder it is to make up from that loss. So for example, in this case, with a 10% drop in the market, you only have to make back 11% or 11.1% to get back to break even. But if you lose 25% in the market, you have to make 33.3% back. And so it's another 8% on top of what you've already lost. And for those people who are continuing to take money out and use it for, let's say, retirement, then it becomes worse. So if it goes on for a year or two and you've withdrawn money on top of that, then it makes the loss even more. Losing 50% would cause you to have to make back about 100% of your portfolio. Some people just may not have the time to do that. So we want to avoid the worst of the catastrophes, I guess, when it comes to risk management, managing that downside, making sure that we lose maybe not as little as possible, but knowing that it could be catastrophic if we don't manage the downside, even if it means missing out on some of that initial upside. We'd rather have that scenario than perhaps lose way too much and spend a lot of time, maybe even months or years, trying to get back to break even. So the potential benefits of that downside risk management really is important. We focused on that this year, and from what we've looked at, from what we compare ourselves to, the benchmarks, the companies that we work with, that we speak to on a regular basis, we feel we've done a very good job this year with that downside risk management.
I think also what's kind of key to keep in mind when we're just talking about this concept is I kind of beat the table all the time about the plan. We had spent, if you haven't watched any of these videos or met with us recently, we spent pretty much all of 2019 developing this plan for our eventual recession with the goal of accomplishing this downside risk prevention. and to make sure that the portfolios were going to be positioned in such a way to really minimize that downside risk.
Yeah, so far so good. So we'll see what the rest of the year brings. But this is kind of an important chart. You know, we won't spend a lot of time on it, but basically we have pivoted a lot of our bond positions to more high quality investment grade areas that typically have demonstrated during most recessions and an outperformance. You know, when we look at kind of, you know, how things typically perform in an equity bear market, you know, generally speaking on the left, when you look at US equities, emerging market equities, REITs, domestic stocks, commodities, high yield bonds, emerging market bonds, hedge funds, you typically see, you know, negative returns that are lasting through maybe all of those in one way, shape, or form. So it's important to kind of just try and smooth out the ride, prevent less of a loss by, you know, investing in high quality. So owning corporate bonds that are high quality, or owning treasuries and, you know, basically non-US bonds, both hedged and unhedged, municipal bonds. Those are good areas to be invested. And sometimes commodities can be that way too, depending on what kind of commodity that you own. So we've spent a lot of time not only preparing for what we felt was going to be a recession, although we felt we were going to have a recession next year, not this year, but COVID pushed us there quicker. But we were readying the portfolios for this eventuality.
So in addition to that, this kind of plays into our next slide. Dan teed it up pretty spectacularly there. Another reason why we're buying this higher quality corporate debt is because the Fed, for the first time in its history, is actually buying high quality corporate debt. They're not buying junk debt. They're not buying any other types. They're specifically buying that high quality corporate debt. And they've set aside such a large amount of money here, and it's been so fast, even compared to the global financial crisis. You can see right here that the Fed actually has $750 billion set aside for purchasing that corporate debt. It's only used down here $37 billion. So the Fed is there. They're able to step in if they don't see liquidity in the bond market, but it shows how much in total resources, just a huge number that the Fed has to be able to dispose of and use in the open market. It's also important to note that the Fed already has used twice as much quantitative easing, so that's that bond buying that we talk about, in these few months in 2020 than it did in the entire global financial crisis.
Yeah, that's important because, you know, the amount of crisis that banks were in, you know, the liquidity, let's say, that came from the Fed was really used to bail out the banks. And typically today, we're not seeing that. The banks are in great shape. The banks have also put aside huge amounts of money already for eventual loan defaults, and those have not come to fruition at this point. I mean, maybe those companies have further problems going forward, but for the most part, you know, they're in relatively good shape, which allows the Fed to put aside this money for, you know, some easing liquidity if needed to be. So this is very encouraging to see that they have not used a lot of money already to provide that artificial liquidity out there.
Absolutely. So one of the things that we were planning on doing was buying precious metals in the portfolios. And typically in a recession, I mean, we specifically bought gold in this case across the board. They perform very well in a recession historically. And you can see this is basically when we purchased it back in March. We had a big uptick up until August. It's kind of tailed off a little bit here, but so far we're doing pretty well on the position. We do have to make sure that we tell you that precious metal investing can involve greater fluctuation for potential loss. But historically, we knew that we were going to get to this point with gold. And so far, you know, knock on wood, it's performed exactly how we would expect it to perform during these times and these conditions.
And a lot of people ask us about, you know, why don't you buy silver or why don't you buy some other kind of precious metal? We know that gold has done very well normally, in very volatile times. It did well in the financial crisis of 2008 through 2010. It was something that we definitely wanted to have in the portfolio to, hopefully, smooth out the ride, and being in an area where it's really been a good place to be. And buying it in March when we did, turned out to be a great move. And so, we'll see what happens going forward. But so far, that's been a nice, balance that we've kind of put in the portfolio that keeps everything a little smoother because of it.
So this is kind of a key slide for us. We've had some money in the portfolio, depending on the model. We've had for a while now money set aside on the sidelines in cash. And we're by no means unique out there as far as on the street. This is money market fund assets basically since last year. And you can see right here is when the market really started to have issues. We've just seen a huge increase in money market assets. Why? Because, well, there's a few reasons. One, during volatility, investors want to have dry powder on the side, but two, sometimes it's better just to have no gain and no loss at the same time. So if you're in cash, you saw a lot less volatility as far as your portfolio over the past 6 or 7 months. But the key thing going forward for us is that we do have this cash set on the sidelines, and it's there specifically to take advantage of volatility going forward, which we expect between now and when we could potentially have a new president or the same president.
Yeah, typically that's a big number, folks. I mean, right now you're looking at close to $4.5 trillion with a T. It's basically sitting in money market funds, and that's increased by about $1.4 trillion since this pandemic really started to heat up in that March-April timeframe. So that proves there's a lot of money, maybe not to come back into the market. Maybe it's a combination of people that have become fearful of the market and put money on the sidelines, or people that are basically continuing to make money doing what they do or on unemployment, and they just don't have anywhere to spend money. I know a lot of our clients that have come in have said the same thing, that they're flush with cash, because even if they had normal money coming in, they would normally be using it on travel or some other kind of expense. And right now, with not a lot to do, a lot of things are still on lockdown or reduced significantly. There's really not been any place to spend it. So money market assets are through the roof, which is great too.
All right, well, what are we going to do in the short term? Basically, this time frame we're talking about is between now and what we've kind of already been doing for the past week, and eventually when we see less volatility. And that's kind of a combination of factors. The major factor is in the presidential election, what we're all talking about right now, but also going forward, what do we see as far as a vaccine, the impact on the virus? But really, this is in the next 2 to 4 weeks, approximately. So regardless of whoever wins the election, there are some common areas that we have targeted as good places to deploy capital, because there are, regardless of candidate, areas that we believe going forward are going to be attractive and continue to outperform.
We really are not going to give you any kind of idea who potentially is going to win. We have no idea. We see the same things that you do. We may have our own personal choices or whatever, but either way, we're looking at this race as it's going to be very close. It's not going to be a runaway no matter what happens. And so we'd rather plan for both situations, because both situations are very likely to happen.
All right, so technology is going to be a common theme with any outcome. I mean, we were trending this way anyway, and then COVID kind of supercharged that. Everyone's working from home. I know that Dan has family that's working from home. My family's working from home. So I think that it was a 2 or 3 month wait just to get a laptop. It's something ridiculous like that. When you're seeing this gravitation towards tech, we want to be able to be positioned for it. So dominance of the FANG stocks. If you're not familiar with the term FANG, that's Facebook, Amazon, Netflix, and Google. There's obviously some other ones that are in there, but those big tech stocks have really done very well this year. We want to focus on good buying opportunities. So what does that really mean? We don't really want to own an index in this case. We're probably going to go with some sort of managed fund or something like that. We want to be able to give the fund manager the opportunity to identify that next Google, that next Facebook, that next whatever it happens to be.
Yeah, typically when you look at time periods where the market's going through the roof straight up with wide breadth, which means everything is going up, then ETFs and typically, passive mutual fund investments do pretty well because, everything is doing well at the same time. In this kind of environment, as you'll see in the next few slides, because stocks are very hit or miss, there are some industries that are doing great, like technology, others are not. If you look at the top 10 stocks that are out there, you're looking at an average return of somewhere above 20%. It's more likely like 25% would be the return from beginning of the year until now. But if you look at the S&P 500, which is the top 500 stocks based on capitalization on their size, when you look at the other 490 and take those top 10 out of there, it's a negative number. So it's a whole different ballgame, right? The top 10 stocks are doing fantastic. The bottom 490, the wide majority of them are in the negative for the year. So the key thing is that, that's typical. I mean, we see that a lot of times. So, if you were in an index where 490 stocks out of the 500 are doing terrible, and you've got to buy a certain percentage of each one of the index, we find that a manager, an active manager can make a difference in an environment like this where he can double up, let's say, or buy more than he would normally buy in, let's say, those top 10 stocks, and buy maybe, the next 10 or 20, and does not have to participate in all 500 stocks because maybe they're not good ones to have. So there are times where Seth and I will be designing portfolios based on, having a lot of ETFs. They're low cost, they're transparent. We like them a lot of times. Most of the times they're very good. But in time periods like this, where there's such disparity between the top and the bottom, sometimes an active manager can do a lot better for us and for you as well.
Well, and what's interesting about that, I used to use the phrase, and it's a completely wrong phrase, that mutual funds were going the way of the dinosaur. They're absolutely not, and it's for specific situations like this. As much as we've seen ETFs become more popular over the years, and I believe there's more assets now in ETFs than mutual funds, although 2020 probably would have changed that. From our perspective, having that active management in this situation is absolutely the way to go. Okay, well, one of the other things that we're going to be going into is, it kind of makes sense. Neither Trump or Biden, neither one of them is going to be able to control how fast a vaccine will get developed. That's on the individual company level. And granted, there's some regulation that's involved, but you can be pretty sure that regardless of whether it's Biden or Trump, they're going to lift restrictions to get it approved as fast as possible. Both of them want to be the knight in shining armor in this. So as we move closer to that vaccine for COVID, we're going to move into health sciences and specifically development. But really, because of the lack of clarity, this is the same discussion we were just having with ETFs and mutual funds. We want a manager to be out there picking the companies that they think are going to be able to develop it quicker and get it into the market and deliver it to people that need it.
Yeah, and that's key. I mean, we don't know who it will be at some point. And obviously, depending on the candidate, of course, they want the vaccine to be here as soon as possible. Again, once the vaccine is actually made and approved to be made very quickly, it's still going to take a long time to make enough to get out to 330 million people here in the US, just us, without going to the rest of the world as well. But the key thing is it could be a very key area to be invested into, and we like it for that reason. So
both candidates, they do plan on increasing infrastructure spending. Trump's planning on doing it while keeping taxes low. One of the things that Biden has said he would come out and do is he would raise taxes to help fund different types of green infrastructure spending. But really the ultimate shape of either candidate's plan, it really heavily relies on the balance in the Senate. If the Senate stays Republican, Biden's not going to be able to get through a majority of these infrastructure spending plans because he's not going to be able to get it past the Senate. So it really, the spending plans are heavily dependent on whoever has the balance of power in the Senate going forward. So where do we eventually get to? This is where we might see some changes between the candidates and our approach going forward. In general, what we've covered so far has really been about what is going to be constant regardless of. So we know that we're going to be doing the technology. We know that there's going to be infrastructure and health sciences. What are the little differences that we're going to have going forward in our plan, regardless of which candidate does win? So one of the key differences is we were just talking about this tax rate. I found this number interesting. So he wants to fund that green infrastructure, windmills, solar, hydroelectric, for example, doing subsidies for electric cars. But they look to, as far as his corporate tax increases, it could have a potential 9 to 11% cut in S&P 500 profits. So this is when you hear them talking about the Biden hikes on the corporate side, this is the danger that you're looking at to be able to fund those green infrastructure bills. Now, depending on your politics, you can think that that's a good idea or a bad idea. But regardless, this is what the projection would be as far as corporate tax cuts, increases, I did that twice now, how that would impact the S&P 500 going forward under his administration.
And we're already seeing some pressure on technology companies that are kind of putting new hiring and expansion on hold right now until we get more clarity after November 3rd, next Tuesday, to see, certainly, at this point, Trump has already said he'll leave taxes the way they are. Biden obviously is the one trigger here that, since he's already come out and said in the beginning that he would increase corporate tax rates, then that typically could cause companies to at least temporarily make an adjustment. We'll see what happens after Election Day. But preemptively, we've actually seen some companies, kind of just put things on pause and wait, for the next week to a month or so and see what happens after the election's over.
Yeah, and I think just to add on to what Dan's talking about, you think about these numbers of 9 to 11%, basically what he said is he's going to come out and change the corporate tax rate to pre-Trump tax cut levels. So you think about what the Trump tax cuts did to the economy and the expansion of the stock market, it kind of makes sense that you would see this kind of a loss reinstituting that corporate tax rate. The numbers kind of match up. So this shouldn't be surprising to economists and people that have been following the markets. So what are we going to do differently? So if Trump retains the presidency, we know that there's going to be defense spending, the infrastructure spending, and the domestic equity. So that's where we're going to focus our efforts as far as a difference in the portfolios. We would be able to have exposures in the portfolios to these areas that we believe, and other people that are absolutely smarter than me believe, will do well continuing going forward under a Trump administration. As we said, the other big difference with Biden is we have that green and sustainable energy. That's basically why we'd be having those tax increases. We would be more global equity driven, so more international stocks, because under a Biden administration, there's a lot of thoughts that we would be opening up more for trade and removing some of these tariffs. And lastly, on the healthcare side, we would invest more heavily in healthcare because Biden would want to expand upon the policies of Obamacare. So going forward, those are really the main differences that we would see in either outcome. That being said, the overall structure of our plan, 90% of it would be what we talked about in the previous two sections other than this one. When it comes down to the nitty gritty, this is really us trying to take advantage of whoever wins the presidency.
Yep.
All right, where do we eventually get to? So we're going to reduce our gold position as policy becomes clearer. So the biggest problem going forward is both Dan and I believe we're not going to know who the next president is on November 4th. So once that policy becomes clear, regardless of what policy that is, we're going to be reducing our gold positions. And the reason for that is now we know going forward that the rules that we're going to play by, and we can then play by them, reducing the gold not all the way, but at least part of it, to be able to take some of the profits off the table and have something more of a traditional portfolio going forward. We're going to invest in tech, healthcare, dividend growers. We're going to reduce those cash positions once we actually have an idea of that policy going forward, and hopefully take advantage of some semblance of stability, because it's going to have to be more stable in 2021 than it was in 2020.
Yeah.
All right, where do we go from here? Go out and vote. I know Dan started off by talking about seeing the early voting. I saw a statistic last night, which was kind of amazing. There have been over 60 million votes already cast in this election. That was more than Mitt Romney got in his election against Barack Obama for the entire election. So that's already happened. So we believe that there's going to be, I believe absolutely, a heightened voter turnout for this. So go out and vote. It's very important for you to partake in our democracy. Trust in the plan and the process we put in place. I say this pretty much every video, but it's not like we're just kind of flying in the wind here. We put a lot of thought into these plans. We get a lot of advice from partners. Dan and I have a lot of discussions on where we think the portfolio should go. So it's something that is a constant discussion point with us. Regardless of Trump or Biden, we're ready for it. We know where we're going to be moving these portfolios. We know what's going to trigger them. And hopefully this slide deck gave you a little bit of an idea and some clarity on what that's going to look like. And finally, stay calm. 2020 is almost over. I mean, we're only a few weeks out from Thanksgiving, and then it's on to the Christmas season. So
Yeah, I mean, the key thing is, I agree with Seth. I mean, staying calm, there's going to be some, outrage. I'm not sure if it'll be widespread throughout the United States. It certainly will be unsettling, and probably certainly will cause the market some volatility today. This is Monday, the 26th. Before we stepped in here, the market was down about 900 points already. Part of that was basically a stimulus package has not been approved, and they don't think it's going to get approved now until after Election Day. And the other part of it is, kind of what they've been saying the whole time, that COVID cases are increasing with winter kind of coming in some of these Midwestern states already. You're starting to see some of those numbers climb. And so, as that starts to happen with no, at least an initial vaccine, getting close to the end and coming to market yet, basically there's more volatility with both of those areas. But, I can't stress enough, staying calm, obviously, is the most important thing as we move towards, the election next week, and then beyond that as well. And to Seth's point in the beginning, make sure you go out and vote. I mean, regardless of where you live. I mean, in New York, obviously, people have always taken the attitude, "Hey, I'm not going to vote because my vote, doesn't count anyway. So what's the difference? I might as well stay home." And this year, especially with social distancing, I mean, these polling places will be very, very busy. And if you wait until Election Day, I still think you're going to experience extremely long lines. So if you have a choice on picking a nice day and waiting online for a couple hours outside versus maybe who knows what the weather's going to be like on Tuesday the 3rd, whether or not they should go on a 2 or 3 hour line at that point, or maybe you just kind of give up and go home and now your vote didn't get cast. So the whole purpose of having these 8-9 days of in-person voting, early voting, is to be able to give people enough time, especially with COVID, to make sure that you're able to social distance, go at your own pace, feel comfortable, that you're not getting too close to somebody, or that you're maybe not going to be shut out of voting. So I would not leave this to the last minute. If you can do anything for yourselves, for your family, for your friends, is encourage everybody to go out, place your vote, wait on lines now versus waiting on lines, let's say next Tuesday. And then at least this way it's already done and under your belt and you don't have to worry about it. So that's a key thing. As usual, I mean, if there's anything that comes up whatsoever that you have questions on, that you're not sure about, strategies, what we're looking at again, please, don't hesitate to contact us. That's what we're here for. We do expect there to be a lot of volatility, but we could be surprised. I mean, we could have one candidate or the other just have a runaway victory that next day, and even with, maybe mail-in ballots are still have to be cast, maybe it's just not even that close to wait for it. So, anything can happen. We're ready for it, but basically the market is expecting to have, and maybe a long drawn out process. We think there's a good probability that by Thanksgiving at the latest, you'll probably know at that point who the president is. I mean, that's our best guess. But again, we just don't know how it's going to work out. So just try and put as many odds in your favor to stay calm. And that if that means going out early, getting that vote, ahead of schedule, I think that's obviously the key thing as we go forward as well. So, polls are open now. I mean, Tuesday, Thursday this week, they're open till 8 o'clock at night. Monday, Wednesday, Friday, I think it's 9 to 5, something like that. And then Saturday is, I think till 4. And then I think Sunday was the last day, next Sunday. I think that's 12 to 5 again. So it's only 5 areas, at least in Dutchess County. If you're living in other counties, you have to kind of see where the polling places are. But, just try and get out and vote. It's going to be very nice to see as many people that can place their vote. I think this would be a great thing that going forward, New York may get to a point where, hey, we're going to do this every year, because if it gets more people to vote that could in the past, then there's no negative in that whatsoever. I think it's a positive. So this could be, the beginning of something that we do continuing on from here. Except hopefully in the future, we wouldn't have to social distance anymore. But at least if the polls are open so much earlier like that, it gives every American an opportunity to go out and vote. So try and do that as well. But if there's anything that comes up, stay with us. So next Monday will be part 3 of part 3, right? 3 parts. And, we're going to go through, how it looks at that point, anything that's transpired between, today, which is Monday, through next Monday. And then, hopefully by then we'll maybe, be seeing some more clarity, but we'll just be able to hopefully reemphasize, that next day, and give you some things to hang on to kind of keep you calm for that next day, as we kind of go forward. It'll be a long, drawn-out battle, I think, with a lot of legal teams, with the legal challenges. Hopefully it will not be as bad as 2000 with Bush and Gore and hanging Chads and everything else that went on with that election. But, stay tuned. So tune in next week for our last part. So have a great week. Get out and vote, and we'll see you then.